The answer basically, I'm afraid, is you've got to accumulate coin and bars, both gold and silver. Silver I regard as gold on steroids because, I mean, the gold-silver ratio is just crazy. I mean, at 85 or something as we speak, this is nonsensical. I mean, I don't see it going back down to the sort of 15, 16, if you like, when when silver was treated or valued as money. I don't think we're going to get there. But these levels on the ratio are just absolutely crazy. And as gold goes up, silver will go up twice as fast to bring that ratio down to something which is, if you like, more sensible. One thing that could really drive this very, very hard is the debt mountains that governments have. I think the psychology of it in the West, we are so far behind. We really are. And if you look at the mining sector too, there are mines which are so incredibly cheap. If you have half an understanding of the potential for the relationship between fiat currencies and gold. And of course, the institutions will switch quite rapidly out of the sort of tech stocks and all the rest of it when that bubble goes. And there'll be, walking into trying to find mines. And, how many analysts do they have now? I mean, there are very few actually, good analysts. I mean, brokers haven't invested in analyzing and covering the mining sector. It's a dirty business and all the rest of it. And anyway, it's been dead for Christ knows how long. Why chuck good money after bad has been the approach. Probably surprised a lot of people that despite the price rise, the Chinese are continuing to buy. So are other central banks. So what's all this about? Well, I mean, the answer is quite simple. And that is it's not gold going up, it's paper currencies going down. And this is very, very important. It's very important to get this message early because when the general public finally realizes that it's not the price of eggs or the price of coffee or whatever going up, but actually the purchasing power of their currency going down, then the currency is doomed. And when the general public wakes up to it, I can tell you, the dollar, sterling, euro, yen will all be a lot lower. Now, I put it that way rather than saying gold is going to be a lot higher, because if you think as an investor, you look at gold and you think gold's gone up. I mean, as we talk, I don't know what it'll be when this is released, but as we talk, it's had a good day. I see it's up $18. It's currently trading at 2,712, challenging the levels we saw, sort of 4 weeks ago. If it breaks that, then it's going to go and hit new highs and so on. But do we really want to pay this much for gold? I mean, perhaps we should hang on and wait for a decent shakeout. It's gone too far. But the point they miss is it's not gold going up. It's the currencies going down. Now, obviously, nothing goes down in a straight line or in an even tempo. But I think if you understand that, then you understand that really what your strategy should be is not trading it, but actually accumulating it and accumulating the physical, not paper. Now, this is a very, very important point. And of course, the whole of the investment industry has a difficulty here because gold is not a regulated investment. So how do you get it past your compliance officer? Well, the answer is you go out and buy ETFs. But your problem with the ETF is you don't own the gold. And worse than that, not only do you not own the gold, you don't actually own the shares in the ETFs unless you have specifically decided to take delivery of certificates. Now, this is a very important point because the owner of, or if you like, the owner of the certificates, in effect, is, the clearinghouse, the intermediary, the big boys in the middle, basically, who guarantee settlement, Euroclear, whatever. And why have they got it? Well, I mean, the answer is quite simple. You've got a huge, great derivative mountain, which is absolutely enormous. And the fear is that at some stage we get a crisis and that could be jeopardized. So what they want is they want your stock to have as collateral to deliver in order to ensure that that whole mountain of deliveries of derivatives doesn't collapse. So, ETFs don't get you out of it.
One of the most critical factors that could drive the market aggressively is the massive debt burdens governments around the world have accumulated. In the West, particularly in the United States and Europe, there is a deep-rooted belief that the current economic system will continue indefinitely despite the glaring warning signs of monetary instability. However, we are already witnessing a shift in the global financial landscape, and those who fail to recognize it will find themselves caught in the middle of one of the most significant financial realignments in modern history. When we analyze the mining sector, we find a shocking undervaluation of some of the most critical assets in this monetary transformation. If investors understood even a fraction of the relationship between fiat currencies and gold, they would see the immense opportunity before them. Institutions will eventually move away from speculative tech stocks and financialized assets, particularly once the debt-driven equity bubble collapses. When that shift occurs, capital will seek safer havens, and gold, along with its mining sector, will become a primary beneficiary. The Chinese and other central banks continue to accumulate gold at an aggressive pace, making it evident that they understand something that the Western financial establishment refuses to acknowledge. The gold accumulation isn't merely a speculative play, it's a strategic move to hedge against the devaluation of paper currencies. The reality is that gold is not increasing in value. Rather, paper currencies are losing their purchasing power. This is an essential distinction that more investors need to grasp. When the general public realizes that the rising price of goods and services isn't due to those goods appreciating, but rather their currencies depreciating, the entire fiat monetary system will come into question. That is when we will see a full-blown currency crisis unfold. At some point, the public will wake up to this reality, and when they do, the major fiat currencies, the US dollar, the euro, the British pound, and the Japanese yen will face significant devaluation. Instead of framing this discussion as gold going up, it is more accurate to say that fiat currencies are going down. If we take this understanding further, we realize that traditional methods of investing, such as holding cash, bonds, and fiat-based financial assets, are fundamentally flawed when measured against real money like gold and silver. Investors need to stop thinking of gold in terms of price speculation and instead see it as a store of wealth, as it has been for thousands of years. The strategy should not be to trade gold, but to accumulate it, and more importantly, to own physical gold rather than paper-based gold assets such as ETFs. The financial industry has a significant problem with gold because it is not a regulated investment in the same way as stocks or bonds. Many compliance officers discourage institutional investors from holding physical gold because it does not generate cash flow or fit into traditional financial models. However, this is precisely why gold is essential. It exists outside the rigged financial system. Gold ETFs are often promoted as an alternative to physical gold, but investors must be cautious. When you buy a gold ETF, you don't actually own the gold. You own a paper representation of it, and in most cases, your ownership is not even direct. It is through a chain of financial intermediaries. In the event of a systemic crisis, these intermediaries may not be able to deliver the gold that investors believe they own. This is why owning physical gold, whether in the form of coins or bars, is the only truly secure way to hold the metal. Silver, often referred to as gold on steroids, offers an even more compelling opportunity. The gold-to-silver ratio, which is currently hovering around 80-1, is completely out of sync with historical norms. If history is any guide, silver will outperform gold in percentage terms when the monetary reset begins. While gold may rise steadily, silver tends to move in a more volatile fashion, often doubling or tripling in value within short timeframes. The low price of silver relative to gold suggests that it is significantly undervalued and offers a generational buying opportunity. Looking ahead to 2025, we can anticipate a further decline in the purchasing power of fiat currencies. The demand for hard assets like gold and silver will accelerate as investors begin to realize that the traditional financial system is on its last legs. The central banks of China, Russia, India, and other BRICS nations are already preparing for this shift by aggressively accumulating gold. Western investors who fail to recognize this trend will be left scrambling when the global monetary order resets.
The answer, basically, I'm afraid, is you've got to accumulate coin and bars, both gold and silver. Silver I regard as gold on steroids because, I mean, the gold-silver ratio is just crazy. I mean, at 85 or something as we speak, this is nonsensical. I mean, I don't see it going back down to the sort of 15, 16, if you like, when when silver was treated or valued as money. I don't think we're going to get there. But these levels on the ratio are just absolutely crazy. And as gold goes up, silver will go up twice as fast to bring that ratio down to something which is, if you like, more sensible. So I think, 2024 was interesting. 2025 is going to get even more interesting, I think. I would see these currencies, the fiat currencies, going down in 2025, at least as much as they've gone down in terms of their purchasing power, measured against real money, which is gold. And there are other problems in the background. And I think one thing that could really drive this very, very hard is the debt mountains that governments have. I think the psychology of it in the West, we are so far behind. We really are. And if you look at the mining sector too, there are mines which are so incredibly cheap. If you have half an understanding of the potential for the relationship between fiat currencies and gold, and of course the institutions will switch quite rapidly out of the sort of tech stocks and all the rest of it when that bubble goes, and there'll be walking into trying to find mines. And, how many analysts do they have now? I mean, there are very few actually, good analysts. I mean, brokers haven't invested in analyzing and covering the mining sector. It's a dirty business and all the rest of it. And anyway, it's been dead for Christ knows how long. Why chuck good money after bad has been the approach. I can see that there's going to be some very, very big shifts, if you like, in the entire investment scene in 2025. It's very interesting times, I think, very interesting. I mean, interesting in the sense that, we'll be watching. It's rather like a public execution. You'll be watching people dangling on an end of a rope, sort of speculating how long they're going to be twitching. You're sort of thinking, hold on, this could happen to me. There's a sort of that sort of feeling, watching these developments. For those of us who have, if you like, an understanding of the relationship between money and credit, this is actually a very, very serious junction.
The broader implications of what we are witnessing in the financial world today are staggering. The West's over-reliance on fiat currencies, particularly the US dollar, has placed it in a precarious position. The illusion of stability that fiat currency provides is quickly eroding as central banks around the world recognize the need for a more tangible store of value. Gold and silver for thousands of years have served as the ultimate safe havens. Now, as we see the cracks in the foundation of the modern financial system, their significance is only becoming more evident. Governments, institutions, and individual investors are waking up to the reality that fiat currencies are losing purchasing power at an accelerating rate. The inflation narrative, once downplayed as transitory, is proving to be far more persistent than central bankers and policymakers would have the public believe. With real interest rates deeply negative and the global debt burden at unprecedented levels, gold and silver are becoming the assets of choice for those looking to preserve their wealth in the face of this unfolding economic uncertainty. The aggressive accumulation of gold by central banks is one of the strongest indicators that a fundamental shift is occurring in the global financial order. When governments themselves, entities that have spent decades promoting the supremacy of fiat currencies, are quietly buying up as much gold as they can, it should raise alarm bells for anyone still placing blind trust in the traditional monetary system. China, for example, has been strategically stockpiling gold, often underreported and obfuscated to avoid drawing too much attention. The People's Bank of China, PBOC, has been steadily increasing its gold reserves, a move that signals a preparation for a financial system that is less reliant on the dollar. It is not just China. Russia, India, Turkey, and numerous other nations are following suit. The BRICS nations in particular have been at the forefront of this shift, steadily decreasing their reliance on US dollar reserves while increasing their gold holdings. The West, meanwhile, is lagging behind, seemingly in denial about the ramifications of these developments. If you were to take a walk down Wall Street or sit in on financial news broadcasts, you would still hear analysts praising the resilience of the stock market and the supposed strength of the dollar. But if you dig deeper and look at the real data, you begin to see a very different picture. The structural weaknesses of the U.S. economy are becoming harder to ignore. The debt burden continues to balloon, and despite reassurances from the Federal Reserve, inflation is far from under control. This brings us to the core issue at hand, the devaluation of fiat currencies. It is not gold that is becoming more expensive. It is the purchasing power of paper money that is rapidly diminishing. When people see gold prices rising, they often interpret it as gold gaining value. In reality, it is the currency in which gold is priced that is losing its worth. This is a crucial distinction that many investors fail to grasp. Historically, whenever a currency has been debased, gold has been the refuge. This was true in the Roman Empire when emperors began diluting the silver content of the denarius, leading to economic collapse. It was true in Weimar Germany in the 1920s when hyperinflation wiped out the savings of ordinary citizens. It is true today, as central banks around the world print trillions in an attempt to keep their economies afloat. The end result is always the same. Those who hold hard assets preserve their wealth, while those who trust fiat money see their purchasing power eroded. Let's not forget silver, often referred to as gold's volatile cousin. Silver has historically outperformed gold in bull markets, primarily because it is not only a monetary metal, but also an industrial one. The growing demand for silver in industries such as electronics, solar panels, and battery technology is adding to its long-term value proposition. With global silver production struggling to keep up with demand, we may see an explosive move in silver prices that catches many off guard. A key point to consider is that physical silver is becoming harder to source. While paper contracts on commodities exchanges continue to trade freely, the actual availability of deliverable silver is tightening. Premiums on physical silver have been rising, reflecting the growing difficulty of acquiring bullion at spot prices. This is a sign that the market is waking up to the reality that physical silver is far scarcer than many investors realize. Now let's address an often overlooked aspect of this discussion: government intervention. When the monetary system is under threat, governments and central banks will do whatever it takes to maintain control. This is why, throughout history, we have seen repeated attempts to suppress gold and silver prices through market manipulation. The paper gold and silver markets, dominated by large institutions trading derivatives, create an artificial illusion of supply. However, when the demand for physical delivery starts to outstrip this paper supply, the entire system unravels. We may be approaching a moment where confidence in the paper metals markets collapses. If enough investors demand physical delivery and the exchanges cannot fulfill those requests, the price suppression mechanisms will fail. When that happens, the true price of gold and silver, based on real supply and demand, will become apparent, and it will likely be far higher than current levels. Another major factor to consider is the geopolitical landscape. As tensions continue to rise between the West and the BRICS nations, we are likely to see more moves that accelerate de-dollarization. Sanctions, trade wars, and financial warfare have all contributed to a growing distrust of the US dollar. Countries that were once content holding large dollar reserves are now actively seeking alternatives. A gold-backed trade settlement system, as discussed in previous BRICS meetings, could further weaken the dollar's dominance and push gold prices higher. The average investor needs to ask themselves, what happens when the tide finally turns? What happens when mainstream investors, who have largely ignored gold and silver in favor of speculative assets, suddenly realize the importance of sound money? The answer is simple. Prices will move violently higher. Sentiment in the precious metals market remains subdued despite the clear bullish fundamentals. This is a classic contrarian indicator. When everyone is euphoric about stocks and dismissive of gold, it is usually the best time to accumulate. The moment mainstream sentiment shifts, it will be too late for many investors to get in at reasonable prices. This is why gold and silver should not be viewed as short-term speculative trades, but rather as long-term insurance against currency debasement and financial instability. The smart money, central banks, large institutions, and seasoned investors is already positioning itself accordingly. The question is, will individual investors recognize the opportunity before it is too late? To sum it up, we are at a crossroads in the global financial system. The warning signs are all around us: rising debt levels, persistent inflation, increasing geopolitical tensions, and the steady accumulation of gold by central banks. All of these factors point to a future where gold and silver play a far more central role in preserving wealth. The time to prepare is now, before the masses wake up to the reality of what is happening. As Alasdair Macleod often says, we are witnessing the biggest shift in global finance in our lifetimes. Those who ignore these changes risk being left behind. But those who understand the fundamental importance of sound money have a rare opportunity to protect and grow their wealth in the years ahead. The writing is on the wall. The only question that remains is, will you act before it's too late?
Stay informed about the latest developments shaping the precious metals markets with regular updates from the Finance Daily team. Not only that, but as a subscriber, you'll also receive timely silver and gold price notifications and early access to groundbreaking news unavailable to the general public. Join our free gold and silver newsletter today, link in the description.